Hello guys, I'm Saurav. I'll be taking your course in risk management in banking sector. So let me tell you about something about myself. I'm working as a probationary officer in State Bank of India, cleared State Bank PO in 2015, and CIB with Treasury Management as an elective. I'm a BTech in Aerospace Engineering from SRM University, Chennai. Now, what is the importance of this topic? It is a very important topic from exam point of view, as last year around 5 to 7 questions were out of this topic. In times of NPA mounting up, risk management has become crucial for banks. High chances of numericals of basic nature from this topic can be expected. This presentation provides the basic definition of risk and type of risk in banking sector. This can be used as a ready reckoner for revision of the topic. Now, what is risk? Risk is uncertainty leading to adverse outcomes in relation to planned objectives or outcomes. So, what are the adverse outcomes for the bank? It is the loss of their capital or interest income. So, what are the planned objectives? Like the banks have planned that they will earn something out of the loans and advances they are giving or the non advanced business they are doing. So, in banking purview, it is uncertainty leading to adverse financial losses. Risk in banking can lead to erosion in profits and even capital in few cases, like assets turning into non-standard ones, like in case of NPAs. Higher the risk, higher the capital required to meet the financial losses. So, with the help of risk management, banks can minimize the requirement of capital reserve and can expand their capital for creating new assets. Like if they need to, out of 100 crore loan, if they need to set aside 20 crore for risk management, so if they can manage their risk somehow and reduce the capital they have set aside for risk management to 10 crores, then the rest of the 10 crores they can give it to the loans and expand their loan portfolio. So types of risk for bank: credit risk, possibility of losses due to deterioration of credit quality of the borrowers. So, what does it mean by credit quality? Credit quality is like someone unwilling to pay or someone who is not having the capability to pay, either intentionally or unintentionally. So, it consists of direct lending, like as in case of loans, in case of loans to SMEs, micro sectors, infrastructure sectors, BGLC. BG is the bank guarantee and LC is the letter of credit. Bank guarantee is given to a person takes a bank guarantee if he needs to do some project, like as in government projects, and they ask for the bank guarantee that if something happens, if the person is not able to perform on the project he has undertaken or the contract, so then they will deduct the money uh, as some fine from the BG itself, and LC is given for the importers and exporters. So treasury operations and cross-border exposures. Market risk, risk arising from adverse change in market variables. So these are liquidity risk, interest rate risk, forex risk, and commodity or equity price risk. So operational risk, risk due to failures of internal processes, corporate governance, and frauds by employees, which are very common these days. Liquidity risk due to funding of long-term assets by short-term types. So funding risk, urgent funds to replace bulk outflow. Now, I'll give you an idea about liquidity risk. So, what banks generally do is they fund a asset, that is a loan, with a liability, that is a short term, you can say FD or deposits with the banks. So, what is the funding risk? Urgent funds to replace bulk outflow. As in few cases, if a customer takes out around, let us say, much of the of his amount, let us say 10 crore, 20 crore, 30 crore are required by the customer at a certain time. So the big banks can afford to give them the money urgently, but the small banks, like the cooperative banks, they run into the funding risk because this much amount they cannot afford to give at one go. So time risk is need to compensate for non-receipt of expected inflows of NPA, like NPA. So need to compensate for non-receipt of expected inflows. This means ki the banks are already expecting their cash flow, and they plan accordingly that they need to reinvest the cash flow by giving the credit to other parties also. But in this case, what happens is, if a loan turns bad, then the inflow will stop, and they need to compensate for this thing. So call risk, bank lose profitable business avenues. Like, if there is some infrastructure project and bank want to give a loan in this, but due to some issues they're not able to, then they are running into a call risk that they're losing on profitable business avenues. So rate risk, guys, this is very important from bank's aspect, and questions can be expected from these kind of topics, like interest risk, rate risk, exposure of banks revenue to adverse interest rate movements. So what are the types of interest rate risk? Gap or mismatch risk. Due to holding different value and maturity assets and liabilities, creating exposure to unexpected changes in the level of market interest rate. So I have given an example also. That is, FD maturing in 5 years, having interest rate of 8% is matched with home loan maturing in 11 years with floating rate. Now, what is the risk here? The FD the bank need to pay, in the case of FD, the bank need to pay s- uh, a similar equal amount of interest rate throughout the maturity, till the maturity of the fixed deposit. But in case of loans, the rates can keep on decreasing, can increase and decrease. But nowadays we can see the MCLR is going on decreasing. So in this case, there is an effect on the interest income of the bank. So this is a gap or mismatch risk, that the gap they have created for the profit margin they have created, it will be reducing. So basis risk, interest rate of different asset liabilities and investment change in different magnitude. So all the investments and assets and liabilities do not follow a similar pattern for increase or decrease. They increase in different directions. Like, let us suppose FD rates change at 20 basis points, that is for 2%, from 8% to 10%. The matching loan rate is changing by plus 100 basis points, that is loan rate is increased from 10% to 11%. And investments, the return on investments had decreased by 1% or 100 basis points. So this can lead to huge interest income loss. How come? Like, from 8% to 10, let us suppose that 8% is the FD rate and loan rate is 10%. So 2% is the margin. In this case, the FD rate, bank need to pay 2% more. So 10% they need to pay, and they are getting 11%. So 1% will be the loss overall. So yield curve risk, due to change in yield over the maturity of long-term bonds. So, guys, in the previous slides, you can see there will be a topic covered for the bonds and yield curve also. But let me give you a small overview that if the coupon rates are same, let us suppose that the coupon payout of months annually is 10%, and the market rate increases, then the yield automatically decreases in this case, because the bond will be sold at a discount. And if the market rate decreases, the yield increases, at the bond will be sold at a premium. So reinvestment risk, interest rate risk at which future cash flows will be invested. Example, 100 rupees face value bond with 10% coupon rate with semi-annual payout will give 50 rupees cash flow semi-annually. The reinvestment of 50 rupees at lower interest rate will be a reinvestment risk. So net interest risk position. Banks always have assets, loans, or are greater than liabilities. If interest rate move downward, net interest rate will be affected, which is net interest position risk. So how come they move downward? Like, let us suppose the FD rate decreases and the bank uh, assets like loan rate also decreases. But if the FD loans decreases with a greater magnitude, then there will be the net interest rate risk position. So forex risk due to volatility in exchange rate movements. Like as we can say in today's market, there is a lot of volatility in the exchange rate of either US INR and other currencies also. So market liquidity risk. This is covered in the liquidity itself. The risk arises when bank unable to conclude large payments like payment of large deposits on demand. This is derogatory for bank's reputation and this is the existence of the banks. The other kind of risk are counterparty risk. So this kind of risk arises when the trader is unable, trader or a corporate is unable to pay a loan because he hasn't, because his customers have defaulted on that. So by definition, if we go risk due to inability of a borrower to pay back due to counterparty default. As in case of trading unit, the trader defaults on loan as his counterparty, that is customer defaulted. So what is a country risk? In case of country risk, keep in mind that the customer wants to pay, but due to some policy changings of the nation, he is unable to make the payment. Non-payment or default arises due to policy changes in the customer of the country. Sorry. So operational risks, losses due to inadequate or failed internal processes, people or event. Transactional risk arising from both internal as well external frauds. Example, branch managers siphoning crores in bank frauds. These days, in case of banks, transactional risk is very huge. Actually, what happens is sometimes due to while NEFT, RTGS, or any check transfer, also there are a lot of transactional risks which are arising intentionally or unintentionally, and we need to check it. Like in State Bank, there is a maker and checker concept in which if a person makes a voucher for a this thing transaction, there will be an officer to check it and pass it. So compliance risk of legal or regulatory sanction, financial loss or reputational loss that may suffer due to failure in compliance in RBI guidelines. These days KYC compliance is very often not done. So that's the reason that RBI is imposing huge fines on the banks itself. So strategic risk arising from adverse business decisions or improper implementation. As in case of nowadays, wallets are in limelight, but few banks have advanced with a project or a wallet which is not working properly, and they have failed. So this is uh, this led to a loss for the bank also. So reputation risk is risk arising from negative public opinion. Example: State Bank for customer service, cooperative banks for deposit safety issues. Now, this is the overview risk in banking and financial services. So you guys can, what you can do is you can just quickly go through this table, this and go through this chart and revise what kind of risk come under what kind of category. Thank you.